Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Caitlin in Omaha, Nebraska.
Hi, this is Caitlin from Omaha, Nebraska, and I have a question in regards to the pay versus repay income-based repayment programs. I'm currently in the pay program, but I'm in a situation where the interest I'm accruing every month is higher than the payments I'm making. I know that the repay plan has some subsidies for this, but comes with the disadvantage of a longer term of payments. So my question is, what's to stop me from switching to the repay plan until just before I hit that 20-year mark for the interest subsidies, then switching back to the pay plan at the last minute so I only have to make 20 years of payments? Will they go back and retroactively add back all that interest that they subsidized? Thank you.
Thank you, Caitlin, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
This is a really good question, kind of an interesting question because of kind of the disproportionate term between pay and repay plans or repayment plans. So I assume, Caitlin, because we are in pay or repaying, we're talking 20 or 25 years, that the goal is to pursue forgiveness that's non-PSLF forgiveness. So this means that you're not working for the government or a 501c3 nonprofit. And typically for borrowers, this makes a lot of sense when you don't have access to that type of employer, and your debt to income ratio is typically higher than 2-to-1, meaning I make $100,000 and my loans are $300,000, so I have a debt to income ratio of 3-to-1. So this is actually an interesting question, and the real answer here is that we're not even really sure. So no one's really even close to earning non-PSLF forgiveness. I think the earliest is going to be like end of 2027, 2028. So it's kind of hard to say how this will be treated. My understanding is that the interest on your current repayment plan capitalizes whenever you voluntarily switch out of either plan. So you'll have to consider how much interest would be capitalized and add it back to the principal with each switch. So what this means is that you have basically two columns. You have the principal column, and then you have the interest column. When it capitalizes, all that interest gets dumped in the principal column, and then that interest starts basically accruing more interest. So my guess is that if the question is, will they go back and retroactively add back in the interest they subsidize? I think no. I think half of the interest would be capitalized when the plan is changed from repay to pay. And then some of that may be forgiven depending on income at the end of the 20-year repayment plan. I think probably the biggest question between repay and pay is not necessarily the interest subsidy that repay allows or affords you. It's really a question of like other incomes. So my thought is that repay is great for the interest subsidy, but if you're seeking a forgiveness strategy anyway, it's like, who cares? And I don't mean to be facetious about that, but really the name of the game with forgiveness strategy is really to pay off the least amount as humanly possible. Mm-hmm. So if you're accruing more interest, it really doesn't mean anything. It maybe is a bit more stressful, because if you started with 300 and you're paying the minimum amount, and after a year you have 315,000, like that's stressful. But if at the end of the day it's going to be forgiven, it doesn't matter. Now, what it could potentially affect is the tax bomb calculation. So you could be forgiven more, which means that because in non-PSLF, the forgiveness is taxable. So the example we give is if you at the end of 20 years you're forgiven $100,000 and you're in a 35% tax bracket, you have to basically cut a check to the IRS of $35,000 in that year. So that's why, and we actually just had a meeting with a client that this was one of the options where she'd be paying $840 towards her loans and then saving another $250 towards that tax bomb in a taxable brokerage account that we're going to invest in an equity portfolio. So it might affect that a little bit, but I think going back and forth, I don't know if they'll get to a certain point where they'll say, hey, you're towards the finish line, you can't change plans anymore, or if they just see that the capitalization of the interest is part of that. I don't know, and they probably don't even know themselves. I think, to me, I would really focus on probably pay, just because if you do get married, if that's part of it, part of your financial plan, the pay, if you file separately, basically discounts spousal income, which could be a big deal. And that's one of the reasons why we do taxes as part of our financial planning process, because so many financial advisors don't understand student loans. By proxy, so many accountants and CPAs don't understand student loans and the tax consequences that are out there if you do, file separately versus jointly. So most tax professionals are going to say always file jointly. It makes sense. But for a lot of borrowers that are in a forgiveness play, you have to actually do the math and see what makes the most sense in terms of how you file year to year. So it's a great question, Caitlin, and I think I love the creativity and trying to find the best path forward. But I think it might be too early to tell. But it might just be that it capitalizes as you switch over, which is probably a better move versus the 5 longer years. My point is that it really doesn't matter in the grand scheme of things, especially if the option is to get forgiven. So just take that for what it's worth.
Yeah, and this is really getting in the weeds, right? I mean, on the student loans. And I think that what I love about the question from Caitlin is I love that there's intentionality in the plan. She's digging deep, trying to understand it. And even if it's vague at this point in time, like I love the intentionality of the question and really trying to understand, and the creativity and evaluating the options. And it reminds me, probably many people that are listening to this episode that are trying to think and understand with their own student loans, do I have the best repayment option or plan in place? There's so many paths that you can go. There is not necessarily one right option. There's forgiveness. There's obviously non-forgiveness options. There's refinancing. There's income-based in the federal system. There's extended. There's graduated. And that decision of which path to go really needs to be married with the rest of your financial plan, and why we believe the financial planning process is so important to making that decision, and also marrying that with a tax professional. And so I would point our listeners here that are digesting your response to Caitlin's question and wondering themselves, do I have the best student loan repayment option in place? Make sure you check out one of our newest resources, the Pharmacist Guide to Conquering Student Loans, available at pharmdloans.com. And you can get access to that book, which is really meant to be an A to Z guide to help you walk through this process. And of course, we're ready to help over at YFPplanning.com. So Caitlin, great question. Again, we thank you for taking time to submit that. And as a small thank you for sending in your question, we're going to be sending you over a super comfy YFP t-shirt. And to those that are listening, if you'd like to have a question featured on a upcoming episode, please go to yourfinancialpharmacist.com/ask YFP, or shoot us an email at info@yourfinancialpharmacist.com. Have a great rest of your day.